All right, how's it going, everyone? My name is Michael EJ. It's been about 5 years since I've posted something on YouTube, back when I was definitely in my option selling phase. But things have definitely changed. Things definitely changed. If you even see what I'm wearing today, you might be able to get a picture as to how life has changed for myself. But wanted to hop back in on YouTube and really start talking about things and decisions I make in my portfolio, which I call the intrinsic growth portfolio. First time getting back, doing more presentation style. Shout out to Oswald the Motorin, kind of his style of presenting things. And we're going to dive more into Ferrari today. Why I believe that stock is greatly undervalued today and investors are missing the potential for the company tomorrow. Let's jump straight in. So, the inspiration for me even going down this route and really spearheading me wanting to go back into YouTube in the first place came from a source that I was not expecting. The Motley Fool. The Motley Fool did a very poor job, in my estimation, in discussing Ferrari's earnings report about 3 weeks ago. Now, I want to caveat this. I am a big Motley Fool fan. You will see that with these stock pitches and me talking through names in my portfolio. You will see that later on down the road. I'm even reading one of the co-founders, David Gardner. I'm reading his book right now, Rule Breaker Investing. Fascinating read. Pretty interesting stuff. So look, I'm a fan. I listened to the podcast. This was off of a podcast episode. I've been listening to the Motley Fool for over maybe 3.5 years now. I never remember them discussing Ferrari, and I can see now why. It just wasn't their cup of tea. They're thinking about it in the wrong frame. All right, they were making the common error, not just seeing Ferrari mainly seeing Ferrari as a luxury car company, and Ferrari's much more than that. There's luxury car, and then there's Ferrari. All right, and it's what I would call Ferrari a luxury utility. And I'll explain what I mean by that a little bit later. But yeah, a lot of connections to even things that are going on in the economy today, and maybe a little bit of resale value of Ferrari. I'm just like, guys, this ain't your wheelhouse. It's fine. And I already mentioned before, see the luxury utility piece and actually see why they deserve a valuation premium. Because it's actually this premium that scared me away in the past. So I'll touch a little bit on that as well. Now, I'll also touch on why they brought up Ferrari in the first place. They took a dip in earnings about 3 weeks ago, a major dip. That was, I believe, somewhat of an overreaction to what management's doing, and I see it actually at a time to buy at, for them, a reasonable valuation. So let's do a quick overview of Ferrari as a company, and shout out to the Intrinsic Value podcast. They're part of the Investor Podcast TIP podcast network, and they did a pretty good job going through a lot of the history and a lot what makes the company special. Although I don't know if they really disentangled what made them special versus what investors typically think, but they did make a lot of the case, and I'm bringing up a lot of their similar points. Also, the Founders podcast, David Sanra, just learning more about Enzo Ferrari just in general. Fascinating guy. Not always the greatest ethic-wise, but that's not the point. He had a great quote, and the quote still holds in the culture today with the company, which is always deliver one less car than the market demands. So that idea of long-term supply and demand balance has always been in the back of the minds for Ferrari. And again, is part of the reason why the stock fell. Now, Ferrari's been around for a very long time. And after a period of actually being mostly owned by Fiat, Ferrari spun out, went public in 2016. And yeah, also the intrinsic value guys. I did not know Ferrari did that much better than the market for that long. So going back to 2016. Almost 3x the annualized return, even with the bumps that have been happening really year to date with the company, stock price wise. Now, this premium valuation, let's start having the conversation right now, because it was scared me away when the company went public. It was scared me away in 2020. It's what scared me away in a lot of 2023 that was the last time I took a very hard look at the name. And now I did some further work and been in the name really since this summer. Around this summer is when I finally committed. But again, you can see the valuations, all right, relative to other peers. What I would call other peers in terms of cars. So Porsche, Aston Martin, Lamborghini, Bentley. Even to those peers, they trade much higher. Now you see, for example, EBITDA margin here. You do see double the next peer, but does that explain the valuations being so much higher? It's a little bit bumpy, a little bit bumpy. But there is a lot of aspects here that typically don't keep in mind. So let's dive a little bit deeper on them. So this is my, I'll call it luxury utility thesis. This is my belief. When I think of Ferrari, I think of a luxury utility. It's three main parts. We got a longer forecast period. I'm going to tell you what that means in a second. Lower relative risk, and a business mix change. And that's what catching the market off guard, at least in terms of expectations. Now, let's just go into theory land for a second. For those who know of discounted cash flow analysis, which we're looking at kind of a representation of that. The value of a business is future cash flows discounted back to the present value. There are ways you can look at the key variables that are in a discounted cash flow and making those projections that the market tends to get wrong, or what I'll say, mismatching expectations, especially relative to theory. So the discount rate to me is definitely the top one, and we're going to discuss that a little bit later. That goes into the relative risk piece. But if we go down the list, forecast period is last. This isn't, you might not even recognize forecast period as a thing. Like even now, in this little example that's in there, that's 5 years. That's a 5-year forecast period. So let's dive a little bit deeper on defining what the forecast period is. Because in a standard DCF, it's 5 to 10 years. Like it's just because the thought process is, especially for the 5-year ones, you can only forecast out 5 years into the future. Really only 2, 3, and then you make some adjustments for the last 2. And it's the same thing with thinking going 10 years out. This is how far you feel comfortable reasonably forecasting out. But that's not what the forecast period is supposed to represent. It should represent a period of abnormal profits. What's abnormal? Well, if you think about things in terms of return on investment, so return on invested capital is a very popular metric. Return on capital employed is another one. You can go down ROE. You can even say broadly ROA. When are those ROI metrics above the cost of capital, or really above the discount rate, whatever that discount rate is? Now, when you look at stocks in general, 10 years is actually a fair assessment, because that's normally around the range, somewhere in between 9 to 12. Is usually when you start backing in and doing a version of expectations investing that I utilize. You recognize it's usually around 10 years. That's tend to be the number, and you can justify a lot of things. But there are a few instances where a company deserves a longer forecasting period. And you'll see over time in a lot of the companies I cover that I'm going to list a few out. But the number one situation is when company management has a true long-term vision, truly thinks further out into the future than your average public company. And what even makes that stronger is if they're an insider in the company. So they have the insider influence to back you up. Like they are heavy shareholders in their own company. That's like an extra kicker. Now, the companies I present here, not all today, I will admit not all today, but at some point in time, they were part of this list. They had a CEO or founder with a very long-term vision, and they acted that way. They acted accordingly. What does this actually mean in real life? Well, what it means is they're not trying to maximize shareholder value. Not in the short term, not in the medium term. Honestly, it's not even on their radar. Like, if you learn more about Costco, you will learn about how they prioritize literally all other stakeholders except the shareholder. And lo and behold, look at the valuation they trade at. Why? Because they deserve a longer forecasting period. They think further out than others. Okay, Berkshire has a lot of those same views when you think about Buffett and Munger. I don't know why I messed it up. Charlie Munger. All right. So different companies have thought about this. Amazon's another one that comes to mind when Bezos was at the helm. But there's another one in the middle there, Hermes. Now, Hermes is interesting because I see Hermes as one of 3 companies that I will call the long-term luxury big 3. These are the companies that you need to think about maybe in that utility sense. Now, Hermes is one. Remember, very long-term focus, thinking a lot about supply and demand dynamics. Hermes is one. Rolex is two, even though they're a private company, they definitely count. And Ferrari's three. Now, all three of these companies have something in common in terms of their sales cycle. Like, if you're somebody who's interested in getting their headline product, you gotta jump through some hoops a little bit. You gotta prove yourself, buy some smaller things, get on a waiting list, wait a couple of months, maybe sometimes longer than a year, then get a call. Hey, I got something available for you, but it's only for this small amount of time. And people normally jump at it. So that's how they actually build things out. They're not trying to maximize revenue or profits today. They're just thinking about how can we have a sustained long-term demand. All three have this for their headline products. But with Hermes and Rolex, where you can say the headline product is around the $20,000 to $40,000 range, with Ferrari, you had a zero. 20 to 40,000. Now we're moving to 200 to 400,000. Very different. That creates something very different in certain people who want to get a Ferrari. Now, that's my reasoning for having a longer forecasting period than your typical investor, especially for something like Ferrari, where I said before 9 to 12 years. I believe that Ferrari should go even further out than 12, approaching 15, if not even a little bit further. Let's move to point number 2, that I have a differentiated view than typical investor here. And I mentioned lower relative risk. I need to put some context a little bit more around that. The biggest disconnect I see from learning discount rates in theory, where you utilize the weighted average cost of capital, versus reality, which is thought of more as your own required rate of return. There's a gap here. And things that sit over here might not sit over there. In all my time in my prior life as an allocator, talking to thousands of managers and learning about some of the most successful stock pitches out there, this is where there's the disconnect. So just want to pull up a few of these reasons why this happens. First, looking at things in terms of a shareholder. So these are different aspects that lead to investors having a lower required rate of return than what meets the eye if you were to use CAPM, or even just the weighted average cost of capital methodology for getting the discount rate in the first place. Now, if we walk down, think about it from a debt perspective, we got a couple more. We got a couple more things to think about. And again, all of these things tie in, and you'll hear me over time touch on all these different aspects. Now, I will say these are the ones that actually appeal the most to me, that click for me in a way that I believe I can see in other businesses that most people cannot see, which is why for companies that have this as a situation, I believe deserve even a lower cost of capital, or at least a lower rate of required rate of return for myself than what you will see with cost of capital. And again, investors who are in the name probably see the same thing. Now, that's why when you're doing like an expectations-based analysis, you need to understand who are the types of investors that are also in the name today. Not who could be in the name in the future, but in the name today, because they will give you a lot of insight here. So, in looking at the automakers and uncertainty, think about it again. Discount rate, cost of capital, required rate of return. These are all different forms of trying to account for the uncertainty that you see for the company going forward. And for me, especially when you compare Ferrari to other companies, I even threw Tesla in there. One big thing to me is having recurring revenue, existing customers. I'm not saying fully relying on those only, but it's nice to have those in the back pocket. Now, if you look at the key customers here, Ferrari to me has the highest quality of customers. Mainly not just super high net worth, but the collectors. It's the collectors that are of interest that I think are a little bit underappreciated. Now, there's some other aspects too. Economic elasticity is definitely lower for Ferrari. Like what's going on in the economy does not matter for someone who's buying a Ferrari. even relative to all these other automakers, even relative to that. And then you definitely get down to the margins. The margins can explain a lot, because even Aston Martin and Tesla, they're positive, they're barely positive, still in the single digits. Whereas with Ferrari, far and away ahead, far and away the highest. So because of this had me thinking, okay, longer forecasting period relies a lot on existing customers, and even that there's an element of just doesn't matter what's going on in the economy. This is what the utility piece comes into play. This is where it came into play. Just think about it from that perspective. Because utilities have a similar profile, right? Especially on the low economic elasticity front. It's really a big thing. Really a big thing here. So this is what leads to me believing that Ferrari deserves a higher multiple, because you got to lower that required rate of return, especially relative to automakers, all other automakers. And here's the thing. Current investors in the stock, or who's been invested since the IPO, they agree with me. How do I know? Let's first compare some betas. Yeah, I just poo-pooed on betas and cost capital for a second. But let's just go down this route for a second. We see the difference between the betas that a utility company would trade at versus an automaker. We see the difference. And look who is way much closer to the utilities. Ferrari. Like, it's not even close. It's not even like it's down the middle. It's like way closer to utilities. So this leads to the discount rate difference. If you do utilities, you will get a discount rate that is about as high as maybe a AAA rated corporate bond. That's the range you'll get at today if you were to do it for utilities. Automakers, much higher required rate of return, especially again utilizing CAPM and weighted average cost of capital to get there. Ferrari, you'll get about 7% actually if you were to do the traditional calculation. So this part, again, this is more important for people who are looking at the stock and who are not invested versus who's already invested. This is where a gap already exists. So I'm with those, and I can see those who are invested, the gap there in terms of uncertainty or like low uncertainty. I actually think instead of it being around 7, I actually think it's a little bit lower, which would maybe even shock some people. But again, when you look at them from the lens of the automakers, which again, that's the lens Motley Fool looks at them at, yeah, way off, not even close. Which is again why the stock does so well, because this is something that's underappreciated. Now, lastly, business focus change. There's been changes with Ferrari over the past several years, actually starting right around the time they went public, maybe a little bit beforehand, but really ramped up over the past few years. And it's the idea of customization. No longer is Ferrari focused on creating a base model, maybe adding, some extra elements to it. Depends on what the customer wants to add. No, they're not depending on that anymore. It's more of, hey, this is Ferrari. You know what we're about. Now, if you want to tinker things and you want to take things to the next level, something that a collector would want to do, then we got you. We can definitely amp things up for you. So before 2010, it was kind of there, but not really. It wasn't like organized or anything like that. It wasn't really that big of a deal. Really started to pick up in the 2010s. This is where the tailor-made and the certain aspects for co-creation really started to ramp up. And again, that's something that collectors would care about. Somebody who's really deep in, maybe even love F1, got into Ferrari from that perspective, and somehow became rich enough, decamillionaire status, to even own a Ferrari and go through the hoops to get at least one. That if they got one, they're going to want to get 2 and 3 and 4 and 5, because they see the customization as a way of expressing themselves. All the way to the point that today, 90%, 9 out of every 10 vehicles sold has some element of customization. And especially when compared to the base model, that's an average sale price increase of 30 to 50%. Especially when you also throw in like the idea of hybrid models too into the fray. So because of that customization, I believe that's the biggest thing, and that business focus change is what leads to just an underappreciation, just a broad underappreciation by the market. Because I didn't really touch on it on that last slide, but the idea is stock fell about 20% on earnings, mainly because they mentioned slower growth than maybe expected, which has its ups and downs, at least top line growth, sales and EBITDA. EBITDA is a bad one to focus on. And then second, and probably more important, is that the reason the growth's slowing down is because they're not as focused on EVs. They're not focused on, they're decreasing their focus on EVs, which from a long-term management perspective and who your true customer is, who you wanted to be, again, that collector, makes the most sense. To me, makes the most sense. But some people got into the name Ferrari, they disagree. So let's talk about it. Now, again, first and foremost, I'd like to start off all my investments and understanding them back into expectations today. So what does it take for me to justify today's valuation? Now, again, shout out to Aswat the Motorin. He has a spreadsheet where you can actually do this exercise. Focus on the multiple, not a reverse DCF. Reverse DCFs are super valuable. But I have found there's a lot of things that can be hidden if you do a reverse DCF. And a lot of places where you can go wrong and you don't know where you're going wrong. It's much easier to tie it all together and connect it back to a multiple. So this is October 30th that this is being recorded. So at that time, Ferrari trades at around 8.5 times EV to revenue multiple and 23 times EV to adjusted operating profit multiple. I just made a comment about EBITDA. I'll talk to you about operating profit in a second and what it actually represents. But to even get to roughly an 8.5 times EV to the sales and 23 times EV to adjusted operating profit, these were the figures that needed to be utilized. Again, given all the context I've already talked about with the company. So we got we're already on the higher end, 12 in terms of forecasted years. Expected growth rates, a little low. I'll admit, a little low. I understand the freak out, getting a little bit lower, but there's other elements here too that are good. Now the big thing is going from this change to this change. Now, as you can see, there's a little bit lower of a discount rate, and I do think to keep up the same amount of growth with the focus on customization and you can get more out of your sales price, that plays a role in my forward-looking thesis. You don't need to reinvest as much, but again, these are minor changes. The big one is the forecast year. The forecast year to me is the big one that really sticks out, and that's where I have the most differentiated view. So with this differentiated view, what it leads to is the gap in valuation today versus in the future is about 20%. Roughly about how much as the stock fell back in earlier part of this month, which to me is a little crazy because at that valuation, I thought things were starting to get a little bit heated. But now I look at it, it's like, maybe that was the right valuation all along. And just a quick sensitivity analysis to kind of see how this would play out. Just making the other changes and then moving down from 12 years all the way down to 15. And again, I even think it could be, you can make an argument that's even longer. You can even go further out into the future. 18 years, I mean, that's the gap. So when you look at this gap over, let's say a 3-year CAGR, let's say it takes 3 years to close that gap, that's a little bit less than 6%. So that's a little bit, that's part of the IRR for me, my investor rate of return, or what I believe my rate of return will be. First 6% is just closing the gap in valuation. Now, a quick tangent on this intangible assets piece, because this explains operating profit for me, why it's a big deal to me. All right, so I make adjustments in all my valuations for research and development and sales and marketing. There's a lot of academic research that points to this idea that the more R&D and S&M play a role in a company's operations, the more likely the market's going to get things wrong when trying to evaluate them, especially through a traditional lens. Again, plenty of academic research about it, and even some ways that you can make the adjustment. This is the way that I've come around to it. So I make the adjustment for most of R&D and half of sales and marketing. Let's make those adjustments. And what I mean by adjustments is that I remove them from the income statement and add them to CapEx, essentially. What does that mean? That means higher margins, higher cash from operations, but at the same time, higher CapEx, which leads to a higher reinvestment rate. So if we were to look at this from a perspective of Ferrari, these are initial values and how things happen when I reclassify things. So you can see the total adjustment that's being made. And the biggest headliner here is in making these adjustments, you essentially double CapEx. CapEx is or long-term investments, they double. Now, we got focus on, what I believe will be, over the next 3 years, the CAGR in terms of just closing the valuation alone. But what about the growth of the company itself? The idea is intrinsic growth. So the company needs to fundamentally grow itself. So have a base model, again, focus mainly on the number of cars sold and having that as the flowing through as the revenue and explaining most of the profits. And again, with Ferrari, they don't want to really push the envelope on selling cars. They want to keep cars sold under 15,000 at least to 2030. I think that will actually be a little bit of a challenge, but I'll have them stop just short by 2028. But where my differentiated view, especially in terms of the business focus change and the idea of customization and keeping your focus there, it shows up in the average sales price and just the contribution margin or profit per car sold. So we already see over the past 2 years where the average sales price increase is double figures, at least in percentage terms. I do see a slowdown in that, but even with that slowdown, things still look pretty strong. And again, a lot of that slowdown, if you keep it on the customization front, is going to continue to increase profits, going to continue to increase the margins. Before tying it all together, let me just let you know of how I make investment decisions. Combine essentially three numbers. I already talked about valuation today, the difference. We got intrinsic growth tomorrow, and we got expected shareholder yield, which is essentially taking a fraction of what shareholder yield is today over the past 12 months. Based off of that, I want to compare that investor rate of return. So how I add all those three numbers together, and if it's above what I expect for the sector in aggregate, it's eligible to get into my portfolio. So what's my view on tomorrow's valuation? Well, first and foremost, if things were to grow as I expect them to grow and trade at maybe slightly higher than what the valuations are today, which is a 9x EV to sales multiple and adjusted operating profit multiple of 24 times, then yeah, we get about a CAGR around 9%. Yeah, because I tend to hold for aim to hold for 2 to 3 years. So I put it all together from that perspective. I also put a little bit more weight on the EV to sales multiple. Yeah, I make the adjustments for operating profit, but if I lean on that, everything will always look great. So I don't want to lean on it too much. And you can see in these numbers here, the difference between if I lean completely on operating profits versus revenue, just a little bit more conservative. So if we were to take this all and add it all together, valuation difference, about 6%. Intrinsic growth tomorrow. So if I were to price the value the company 2-3 years from now, about 9% difference between today and tomorrow. And right now the shareholder yield is about 2% for Ferrari. So cut that by about 40%. So bring it down to 1.2. Add it all up, I expect over the next 3 years, 16%. 16% annualized return. This is in comparison to about 8% of the broader consumer discretionary sector. So what I'm essentially saying is over the next 3 years, I expect Ferrari to double the sector. And again, a lot of that comes from the valuation difference today, which is, it's actually funny. This is the first time I'm getting back on YouTube, and normally it's that second column. It's the intrinsic growth tomorrow that's the driver. So it's interesting seeing that Ferrari is the first one, and it's more of a valuation piece, which you would expect more from a value investor, and I'm definitely more in the growth camp, quality growth, or at least what I'll call myself intrinsic growth. Now, I do think it's very important to utilize scenario analysis, especially for the future. This is one aspect, again, that I believe most investors get wrong. They think so much about the valuation today versus what the valuation could be in the future, given different scenarios. So I have the classic base bull bear, and if you look a little bit closer, the probability piece, I do see the bear case playing out way more likely than the bull case here. Partly because there's such a high weight on the base. So if the customization focus isn't as much, but it's still pretty high, and maybe they put a little bit more focus on the EVs than I would like, I still see it will fit somewhere in the base case. And keep in mind, this differentiated view really comes from the idea that they're putting much less of a focus on electric vehicles than the market would like. Even though I do believe that's best for their business to do it just that. Gradually go into EV. Don't need to jump all in. They want maybe 20% of sales to be there by 2030. They did originally put out 40%. I get that. I get that's the problem. I get that's part of the the drop, but I can live with that difference. More than happy to live with that difference. So we have that, and I also view Ferrari as what I would call one of the names where I'm trying to hit a single or double. That's how I classify investments. Is this more of a single or double, or am I trying to hit a home run? If it's more of a home run, the bull case got to carry the weight. If it's a single or double, I do want a high probability in the base case, which means in this more scenario analysis view, probably to more downside than I would like. So just to bring that point home a little bit more, let's look at the bear case. And if you look at it from a total IRR perspective, it also hits valuation today. So saying that maybe the valuation gap isn't as wide as I would like, although I still think there's one there. But now we got negative intrinsic growth. And yeah, in this view, I don't lose money. I'm not losing money, but again, I see myself trying to beat the market, so try to put everything through a relative lens, especially at the sector level. And at the sector level, this will suck. Look at all that negative intrinsic growth. It will stink. Which is unfortunate. But hey, every investment, you gotta take some type of risk. It's hard to pick a stock and be honest in picking a stock when you have your negative still being better than what you could do just investing in that sector broadly. So, and you see it all together. I even see the weighted average still being a little bit lower than my base, but that's still a positive. So it still qualifies. And I actually will let you know today is my largest overweight. I'll admit Google might have something to say about that, given what's happened on earnings. But today, like at this very moment, Ferrari is my largest overweight. But is this the only analysis I do to determine that? No. Kind of, but no. There's other aspects to my process. Believe it or not, this is all just part one. This is a 3-part process. For me, not just seeing if a stock's eligible to get into the portfolio, but determine what I'll call its active weight. I don't view names in terms of what's the absolute weight in my portfolio. I view it in an active lens. If I look at it from an absolute lens, NVIDIA was always going to be the largest weight, no matter what. But NVIDIA is actually about a 0 active weight right now, maybe a little bit higher. This is much higher. So instead of talking through those second and third parts of my process, I decided to hold on to that till what's the next stock I'm talking about next. This is where maybe some help from you all will be helpful in the comment section. Let me know what will be of interest. So some choices. Well, there's one company that just had an announcement, I think they just had an announcement, speaking of NVIDIA, that also has a customization piece. Like, it's a lot of hate. It's a very love-hate relationship. I was definitely in the hate camp before. And I'm slowly coming around on, so I want to dive a little bit deeper there. Another company that I've hated on, and let's just say events in 2021, definitely solidified some things, and I haven't really looked at the stock since. And I am learning that even if the stock has gone up a lot, doesn't mean I shouldn't take another look at it and add it to the portfolio. And then there's an active decision that I need to make between these two companies. And they're both different plays on data centers. And they're starting to become correlated bets. I need to reduce one of these bets or even go larger than the other. I just need to pick a side. So help me decide which one to do. So until then, and probably next time you hear from me, it'll be a podcast, not related to this, but a podcast is a little bit different. So I'll tease you there. But until we get to do another one of these stock picks, stay invested, stay sophisticated, and I'll talk to you later.